Inflation numbers have been coming out higher than expected, and the Federal Reserve is saying that they will be raising interest rates 3 times in 2022, along with tapering their purchases. What does that mean for the Philadelphia suburbs and our housing market for buyers and sellers and across the nation? Let's get into it. The sky is falling, the sky is falling. First, let's hear from our chief inflation correspondent, senior analyst, Jude Lawrence. Jude, what do you think of inflation and what interest rates are going to do to the Philadelphia housing market? Well, there you have it, folks. All right, let's get into what this article has to say about the Fed accelerating the taper of bond purchases and eyeing interest rate hikes. They are saying that the Federal Reserve will phase out its bond buying stimulus program by March, much faster than previously planned, and it's able to raise interest rates more aggressively to combat U.S. inflation. If we look over at this article here, we can see that U.S. inflation is just at a 39-year high, and some argue an all-time high if you look at different ways of calculating inflation. They say it might be actually 14-15% higher than we had in the 80s and 70s, I believe, even. Anyway, you can see here the inflation numbers, but they're talking about how when we calculate inflation now, it's actually adjusted differently than it was back then. What does this mean for the Philadelphia housing market? Let's do some math. Okay, so let's take a look at what's going on around the Philadelphia suburbs in Chester County, and that will kind of give us an understanding of what's going on overall. And we can see our market statistics here. Number of closed sales is still, pretty strong. You can see what's been happening to the median sales price. Right here, we hit a peak in June of $450,000, and right now we're about $435,000, and you can see it kind of dipped and went back up. Back in 2016, we were at $295,000. So been a big increase. If you go to a house for $295,000 down in 2016, you're now basically selling that same house for $450,000. The days on market, as you can see, has been dipping but slightly trending up. What about when we compare this to what interest rates have done? So here's a pretty good historical graph of what interest rates have been doing. And you can see they've been as high as 18-20% back when we had high inflation back here, and that's what they did to really crush it. And you can see where we are right down here. So let's take and look at what's been happening recently. Seeing this slight uptick here. And I think that kind of shows you why we had a slight downtick in prices right here. And that's what interest rates do to prices. So let's look at why that's the case with a little mortgage rate calculator. They're saying that interest rates may go up, let's say 3 times in 2022. So that's probably going to be a 1/4 point per time unless they get more aggressive. But let's just be conservative and say that's what they do. So right now the interest rate's at 3.82, and let's just say that went up to 4.25. And let's put this average at 450, which is the average in Chester County. You can see that puts your monthly payment at $2,214 at the higher interest rate, and at the lower interest rate you'd be at 3.5 just current. So that's $200. So let's look at what would we have to do to change the price so that the payment's the same, because many people are payment buyers. So if we put this to 4.25, and I've got to get it back down, that would decrease the price of the average house by about $30,000, which is about 8% drop. Compare that to what inflation's doing, which is going up at about 7% a year. So what does that mean about what interest rates would do to the housing market? Basically, if you were inflating at 8% and then interest rates take you down at 8%, what ends up happening is they cancel out and the housing prices level. So if you're buying a house, it actually is a bad thing for you in terms of what's going to happen, because waiting is just actually going to make you end up with a higher payment, because if the housing prices stay level, then you actually are going to have a higher payment because the interest rates have gone up. You would need prices to dip and interest rates to go up just to get at the same payment. So that's a really serious thing to think about. Waiting is not going to benefit buyers right now. Even with the foreclosures coming through the market, which are still at a very low pace. I got a video on that as well if you check it out on my channel. It's not going to be great for buyers. For sellers, it's going to kind of be a little worse, I would say, because the prices are stabilized. The market's going to get a little bit less aggressive. Maybe you're going to have inspections on your house, maybe those kinds of things. So again, I don't have a crystal ball, but I'm trying to make predictions based on math. One thing to understand with real estate prices is they don't like to move very much. So if they stay stable, that's kind of good. One of the things to think about with price increases, they don't like those because appraisers come in and say, hey, a house just sold for X. I'm not saying it's going to sell for X plus more. You know, they don't want to see price increases as an appraiser. So the way you get price increases is really people paying cash on top of appraisal. And that slowly ratchets up the market, which is what we've been seeing, right? Like the market doesn't just fly up because people can't get loans. Now, the other thing is prices don't like to go down very much because people say, hey, my house was just worth $300,000. I don't want to sell it at $275,000. I just thought it was worth $300,000. I'm not happy. So prices like to stay stable if they can, based on the dynamics of the real estate market. It's not really like the stock market. There's nobody that comes in when you're buying a stock and says, hey, Tesla's not worth what you're paying for it. We're not going to let you buy it. But that does happen in the housing market, and it's important to understand when it comes to price. The thing that the market wants to do is stay stable, and that's probably what it's going to do in 2022. So long story short, we're probably not going to see a housing crash, which is the intention of the Federal Reserve, is what they're trying to do. They're trying to stop inflation with the interest rates. So we're not going to see a housing crash in Pennsylvania, likely just from 3 rate increases, but it is going to probably level off the prices if people's wages stay the same. Now, if wages do rise, then people's affordability will actually go up, and we might still see some continued increases in housing because the inventory is just so tight and there's so much competition. I just bid on a house last night and there was 15 offers on this house. We went $25,000 above asking, still did not get the property. It's still crazy out there. There's not a housing crash on the horizon, but you can see what the impact is going to be of increasing the interest rate 3/4 of a point over the next year. So, long story short, prices are going to just stay about flat based on the math. And that's about as best I can do because I don't have a crystal ball, but I can do math because I'm an engineer and I'm a nerd. Thank you so much for checking out my videos. If you like this and get good content and interested in real estate in the Philadelphia suburbs, please like and subscribe, and I'll see you next time.